some clouds gathering over the skies after a long time, whether consistent compounders will continue to be holding out for investors. Saurabh, it's good to see you again, and thanks for joining in today. How are things looking for the consistent compounding universe, given that some COVID clouds have gathered on the horizon again?
I think, as they say, right, when the going gets tough, the tough get going. So it's always good to have some clouds in the horizon. We worry about the days when people tell me that the sky is blue and there's a 3-year economic recovery with no interruptions ahead. There are bound to be some challenges from COVID. I suspect there'll be some other challenges as well, including the rate rise cycle. And consistent compounders are geared to deal with such challenges and plow through with around 25% free cash flow compounding, which has been their habit over the last couple of decades.
It's interesting that you speak about some clouds, because till a month back, everybody seemed to be so gung-ho about the market and everybody was talking about a new capex and earnings cycle. Did you worry a little bit then that, if indeed it's a new capex cycle, then while consistent compounders do well through different weather systems, sometimes in a pronounced capex cycle, they tend to take a bit of a backseat. Were you beginning to get a bit worried about that?
So I think what we were worried about is the sort of the more fundamental manifestation of a roaring capex cycle. If you look at our country, typically when the capex cycle really gets going, CPI inflation fires through at 9-10%, right? So if I cast my mind back to say 2011, when I think that was the last time the Indian economy really was heated up, CPI inflation at 10-11% creates input cost challenges. Wage inflation tends to go to 20-25%, and that was something we were worrying since last November, December, and we'd engaged quite intensively with our investee companies coming into the second wave of COVID about their plans for high input cost inflation. And what we learned, left us feeling fairly confident that as input cost inflation comes through, our investee companies will be able to use that to gain market share from weaker competitors who don't quite have the strength, either in terms of, say, working capital or in terms of bargaining power, to deal with input cost inflation. So my view is, regardless of whether the second capex cycle comes sooner or later, I think input cost inflation will now be a recurrent theme in India for the next couple of years. And this is what we have seen so far in our discussions with our investee companies. We think they're very well placed to deal with the margin pressures that will now mount as we get into a more active economic expansion mode in our country.
What about financials, Saurabh? Because that's been the one sore point. I mean, while they have not collapsed or anything like that, even the good ones have not exactly outperformed or kept pace with the index. How do you read this phase for some of the bluest of chips in the financial space, like the ones you own, like HDFC and Kotak, etc.? Why are they not outperforming, even when people talk about a new capex cycle and a new earnings cycle? Why are they not participating?
So then I think this is a movie that many of us have watched several times before, which is that the early part of an economic cycle, where the previous cycles crumpled financials suddenly show surprising asset quality development, positive surprises on the asset quality side. So the early part of the economic cycle, the previous cycle's casualties show significant asset quality expansion, and they seem to get a fillip in their share prices as the market gets pleasantly surprised. But then as the economic cycle wears on, typically you see the tried and trusted proven lenders, HDFC Bank, Kotak Bank, Bajaj Finance, tried and trusted proven lenders who've got the ability to manage risk well. Their asset quality holds up much better over a cross-cycle period. So we've been very sanguine that we don't want to invest with adventurous lenders who've shown repeatedly over the last 20 years that they put shareholders' money at risk. We understand that the adventurous lenders will outperform the more tried and tested names in the early part of the economic expansion, and we're quite comfortable with that. Our view is, let's take a 5-year view, and we are pretty confident that the names that we are backing will comfortably outperform the more adventurous lenders who characterize the Indian banking and NBFC landscape.
Not just the banks, the biggest wealth creators. I mean, let me ask you a bit about some of the consumer-facing financials, like the Bajaj Finances of the world, which feature prominently in your list of consistent compounders. How do you think they are positioned now to face the challenge of these fintechs which are coming up every day? I mean, There is Bajaj Finance, but on the other hand, there is all these Paytms and Creds of the world who are trying to nibble away. Do you think Bajaj can grow at the kind of pace that we have got used to, that kind of compounding in the face of these new challengers?
So I think there are 3 points to note. The new challenges, without exception, are very small, right? They create a lot of news, they create a lot of hype, and God bless them, they sponsor a lot of things on TV and in IPL and so on. And a long may that continue. But if you see their loan book sizes, they struggle to get to even say 1,000 crores of lending. So in terms of actual practical impact on the lending landscape, it's negligible. Where their impact is substantial, I do concede, is the hype that they create. But the shareholders are not going to make money through hype, and neither will I lose sleep about the hype that they create, given that their loan books are so small. I think the second aspect is, if you look at the scale of the NBFC opportunity in India, there's Bajaj Finance is barely 3% of the loans outstanding in the NBFC sector, and hence the runway is considerable. So far, actually, Bajaj has only dominated two areas of lending comprehensively, which is consumer durables and the self-employed, white-collar self-employed financing space. There's plenty of canvas for Bajaj to expand in, and the app that they're coming out with, to my mind, will probably be a significant disruptor the broader NBFC space and even the wallet space. And the third aspect is just the sheer amount of investment. Bajaj Finance, if you look at their annual reports and their disclosures, plus speak to the tech community in India, Bajaj Finance invests significantly more in tech talent. Say it's the best computer engineers coming out of the IITs. Bajaj Finance hires way more of them than any of the disruptors do. And if you say the amount of engagement a Bajaj Finance has with a platform like Salesforce, it'll manifold outstrip those that of the other pretenders that one mentioned. So whether in terms of real investment in fintech or in terms of real business creation, I think by far a Bajaj Finance, followed I would suspect by say the HDFC Group and the ICICI Group, would be actually the real fintechs in the country. Most of the rest of the guys are pretending to be fintech, but it's a tough slog out there to actually lend money on the ground and get it back in India.
Tell me about how you're approaching this whole digital universe, because while you don't balk at high valuations, you have very stringent metrics like return ratios, etc., cash flows. On those parameters, have you just given these digital unicorns or the ones which are listing a clean pass, or do you think some of them eventually can become consistent compounders?
So my guru John Kate taught me long ago, 20 years ago, on Sholdham Street in London near Paddington Station. John would have a cup of tea and teach me that the definition of a business model is how a company makes money. So if a company doesn't make money, then by definition, the business model isn't there. Now, that being said, there are some of our technology companies in India, some newer companies, who are generating operating cash flow in their core business, say the one that they began with a decade ago, and then they're reinvesting that cash flow. They're reinvesting the cash flow in say newer adventures in other parts of India, right? And so when we meet these new age companies, we ask them, tell us where you started a decade back or 5 years back, and show us whether in your original business you're generating cash flow.